You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have British American Tobacco, Chemring Group, Pennon, B&M, Doc Martens, and our US company of the week is Adobe. Sam, shall I kick us off with a trading statement from British American Tobacco?
Absolutely. We've not covered a tobacco company for a few weeks now.
So, British American Tobacco, UK's second largest tobacco company, had a trading statement out last week with revenue in the first half looks to be slightly ahead of what management had expected, with annual sales growth guidance being upgraded from around 1% to around 1 to 2%. British American Tobacco saw a return to revenue growth in the US combustibles market, helped by robust pricing so far this year. The first half, low single-digit revenue growth for new categories is expected to improve to mid-single digits for the full year. Underlying operating profit growth guidance for 2025 is unchanged at between 1.5% and 2.5%, and the company also sold around £1 billion worth of its stake in India's ITC. That's enabled around £200 million increase in the share buyback programme to £1.1 billion, and British American Tobacco's remaining stake in ITC is worth around £10.4 billion at current market prices. The group has committed to bringing debt levels back down to the target range of between 2 and 2.5 times underlying cash profit EBITDA by the end of 2026, and the shares were broadly flat on the statement. In terms of valuation, British American Tobacco has a market cap of £79.7 billion and trades at 9.3 times forward earnings, compared with the 10-year average of 10.8. It has a prospective dividend yield of 7.4%. So, modest upgrade, and you didn't see the share price moving very much. It is in an industry in structural decline. I know we've commented on the new categories before. That growth is slowing down, but there are some particular highlights with the oral tobacco, like Bello, that seems to be doing very well. Medium-term revenue growth is guided at between 3 and 5% in terms of revenue growth and 4 to 6% in underlying operating profit growth. The company has a decent dividend, but still has significant debt of nearly £30.5 billion. That was largely left over from the Reynolds deal going back a number of years now. Interesting, the sale of part of the ITC, which is Imperial Tobacco Company of India, which in itself, I believe, is the third largest tobacco company, which obviously British American Tobacco have a stake in, which is a nearly £10.5 billion stake. They're tobacco, but they also have wider consumer goods. So 44% of their revenue comes from cigarettes, and then about 26% from food and personal care, paper and packaging, a further 10%, and they've got an agri-foods business, which is a further 20%. So a bit more of a mixture. Not entirely sure what led them to sell a relatively small stake in that, whether they thought it was sort of over or fair sort of valuation. But anyway, overall, I think at the current valuation, 9.3 times forward earnings, it's certainly not expensive. It's, yes, a business in structural decline, but it's churning out cash. So I don't think there's really much more to add than when we've covered it before. Nothing drastically has changed. And yeah, I think income investors, of course, there are ethical debates about tobacco stocks, probably still quite appealing on the income front. But yeah, I don't really have much more to add than that. Sam, what are your thoughts?
I'm not entirely sure we needed the statement for 1% change in revenue. It seems I feel like for me, you issue a statement, either to signal you've done a lot better than expected and you want to blow your own trumpet and you don't want to wait till the results come out to do it, or you've done a lot worse and you want to brace the investors so that the reaction isn't as bad when the results come out. But to do a statement to say you're 1% off where you thought you'd be, I think that could have waited for the actual results, especially when they do report. They report quarterly anyway, this business, don't they?
Yeah.
So Yeah, it seems a bit pointless. The Indian thing's interesting. I sort of can kind of see it if it's not like a pure play tobacco company. I guess it kind of makes sense. And given your strategy of just returning as much cash to shareholders, if it frees up extra funds to do that, I don't have a huge issue with it. I do find the valuation interesting because it's still below the 10-year average, but it has done very well recently. And I think when you look at that 10-year average, that is including years before like ESG kind of became a thing. So it does feel a lot less popular now. So it's especially when you look at the share price, it's kind of at like levels we haven't seen for, well, it's at 5-year highs now, isn't it? So it's at levels we haven't seen probably since like 2016, 2017.
Yeah.
But then you look at it and the cash it's generating, returning to shareholders, it still doesn't feel expensive. So I don't really know what to do with it actually. So I've got it in my own portfolio. I only bought it about a year ago. So I think it's up like 40% or something, but I'm kind of I've got half a mind towards selling it. But then when I look at the share price, when I look at the valuation, it's just still quite cheap, especially if you then compare it to US peers like Philip Morris.
Do you think part of that is due to the more uncertain world and I suppose market jitters that you've had, whether it be some orange swan or Ukraine that have happened in the last few years? And also, I guess that post-COVID sort of boom and rally when there's a lot of cheap money around and that sort of upping some of the sort of very exciting tech stocks. And then actually you've seen Imperial Brands and British American Tobacco, very, very boring businesses. And I suppose businesses that are in structural decline, as well as people having ethical concerns, hence being sold by industry. That's the combination of those things. Yet its earnings have been very consistent and there being a bit of a revaluation, by the market over the last 5 years.
I think so, because I do think when you look at that share price graph, you can kind of point to the peaks on the graph in the last 10 years and you can say, oh, yeah, that was that event, that was that, that was that. So like when we talk about it, we've still got a way to go, but the highs it reached in like 2016, that was like Brexit, wasn't it? It was just after that when all the defensive stuff kind of rallied. And then, you can see it around, you can kind of geopolitically, you can look at certain points and that's kind of when it tends to be peaking. So I think it is not a dissimilar environment, but yes, it's just difficult because I think if it sort of goes back down to, £25 a share or wherever it's been hovering for the last few years, I'll just be like, oh, why didn't I sell it at 36? But then, like I say, it just doesn't look that cheap when you look at the yield. And as well, I think a few years ago, it's like it was priced for the structural decline, which still hasn't really happened. We saw the stick declines accelerate and then seem to decelerate again. And as well, the non-combustibles part of the business is doing better and better in that time. And, if you'd gone back 20 years, someone maybe would have said, well, we're 20, 30 years away from the end of these tobacco businesses. And, if you speak to someone now, you could probably argue we're probably still at least 20 or 30 years away. Even if the legislation comes in where you can't buy it once you're over a certain, if you're born in a certain year and you've got that cut off, it will take years and years before that starts having a serious effect. And again, you still plot it out, the amount of cash it's generating, you probably still get a very decent return. And yes, I don't know. I don't know what to do with it, but it's a nice problem to have.
Okay. On to Chemring.
Yes, Chemring. So I think it is a business we've covered before, but not for a long time. So I did have to go and refresh what it did. So we'll treat it like a debut, but I don't think it technically is. So for anyone who's not familiar, Chemring, basically they make money by developing and supplying high technology products and solutions, primarily to national defence organisations, security and law enforcement agencies, and commercial sectors such as space and transportation. The company is organised into two main business segments. The first one is countermeasures and energetics. And this segment develops and manufactures expendable countermeasures such as flares and chaff for air, sea and land platforms to protect military assets from guided missile threats. It also produces energetic materials, cartridge, propellant, actuated devices, pyrotechnic devices for satellite launches, missile components, separation subsystems, actuators and aircrew safety systems. The customers are mainly national defence forces, including the UK and US militaries, and also commercial aerospace and space clients. And the countermeasures and energetic side of the business makes up about 58% of total revenue, or it did based on the 2024 figures. For sensors and information, this segment focuses on developing and manufacturing electronic countermeasures, chemical and biological threat detection equipment, and explosive hazard detection systems. It also provides consulting and technology services for security critical issues, including cyber and electronic warfare solutions. Customers include defense, security, and law enforcement agencies, as well as critical infrastructure and commercial clients. And the sensors and information division accounts for about 42% of revenue. In terms of the geography, it's pretty well diversified. So again, based on 2024 figures, UK was 229 million revenue, US 173, Europe 86, Asia Pacific 16.7, and rest of the world 5.9. They have come out with their interim results for the 6 months to 30 April 2025. And the order book was up 25% to 1.3 billion. Order intake was up 42% to 488 million. Revenue was up 5% to 234 million. Underlying EBITDA was up 12% to 39.8 million. Underlying operating profit was up 8% to 27.1 million. Underlying profit before tax was up 6% to 24.1 million. Underlying diluted earnings per share was up 3% to 6.8p a share. Statutory operating profit was up 69% to 29.5 million. Interim dividend per share was up 4% to 2.7 pence. And net debt was up 24% to 93.3 million. They've highlighted that the order book and the order intake is the highest in their history. They said that the revenue growth of 5% was driven by strong performance within countermeasures and energetics. So this is just like a statement of the results, I think, rather than the actual results. So they've kind of just told us what they want us to know, and they've focused on countermeasures and energetics up 20.4%. However, when you look at that, with revenue in total only being up 5%, that kind of implies that there was a 12% drop in sensors and information, which is the smaller part of the business that was 42%, but still not ideal. And I also don't hugely love the way that's been presented because it's just kind of hidden and you have to work it out for yourself. So they've said the net debt increase was expected given the investment in growth capital expenditure. They've said 3.3 million has been deployed into the 40 million share buyback program announced in February. And their longer term growth prospects are strong, underpinned by robust customer demand for their market leading products and services, high barriers to entry across their market segments, and a high quality pipeline of organic and inorganic growth opportunities. So in terms of the valuation, the business trades at a PE ratio of 36 and trades at a dividend yield of 1.3%. I tried to look at why the value was at a PE of 36. So as highlighted with the record order book, they are doing very, very well at the moment, but they said in the near term, they're targeting mid-single digit percentage in revenue growth at group level. And in the medium term, they expect to accelerate this to low double digit as new production capacity comes online, which is where the CapEx has been going. And they've said that sensors and information is aiming for a mid-single digit growth with a step change expected as major US programs ramp up, and countermeasures and energetics expects a step change in growth in energetics as additional capacity is commissioned. And they're targeting annual revenue of around 1 billion by 2030, nearly doubling from current levels. So the PE is really high basically because they're investing heavily in the business and they expect that to lead to a lot of growth. My concern would be, I think the valuation probably would have been quite, based on what we saw when we covered BAE, the valuation probably would have been quite high anyway. They've got these estimates that they're going to aim for, the target. I don't see any reason to suggest why they won't hit the target. But when you look at the growth over the last 5 years, it's kind of not been amazing. And I think kind of similar to British American Tobacco, when you want something defensive. With the amount of geopolitical uncertainty at the moment, the defence sector is doing incredibly well, and they are doing very well as part of that sector. So you're probably at a period where it already would have been really, really high valuations, and then they've got these targets that they think they're going to hit. I just think for me, it's maybe the time to buy was before they came out with these targets, but P of 36 for a business that to date, I don't feel has really proven a huge amount based on not just these results, but the last 5 years when you look at them. So for me, interesting business, probably in a growth sector, but probably quite a difficult business to understand. But in any case, I would have a lot of caution anyway at that valuation. What do you think, John?
Yeah, no, I would agree with you in terms of it being difficult to understand. And I think from there, you don't know really how much of a moat it has. Although it never feels like with these defence businesses that there's a proper free market there anyway, because they need to be very trusted businesses that, like with Chemring, that the US and the UK governments will deal with in terms of sort of defence contracts. As you say, it's got a lot of momentum behind it at the moment and huge order book, given everything that's going on in the world. I guess that's pushing up the valuation a lot, and it does seem very expensive at the moment. So it's not one that I would be going into, but I think it's probably a decent business underneath.
Should we move on to businesses probably not that decent?
Yeah. So Pennon, which is a water company, they had their full year results out with full year revenue rising by 15% to £1 billion. Growth was driven by a whole year's contribution from the acquisition of SES Water, whilst tariff increases were offset by low customer usage in other parts of the business. Underlying cash profit, EBITDA, fell marginally to £336 million as the increased revenue was offset by higher costs. Free cash outflows worsened from £405 to £568 million, largely due to increased infrastructure investment, and net debt rose from £3.8 to £4.1 billion. Full year revenue is expected to increase nearly 18% to £1.2 billion, according to market forecasts. Alongside broadly stable costs, underlying cash profit is expected to increase by around 2/3, and capital expenditure is expected to increase to a range of between £710 and £740 million. The full year dividend was rebased lower from 36.67 pence a share to 31.57 pence per share due to the rights issue. And in terms of the valuation, Pennon has a market cap of £2.2 billion and trades at 1.65 times forward earnings, which interestingly is actually in line with its 10-year average, and it has a prospective dividend yield of 5.6%. I mean, I think this business is completely uninvestable. The debt is very high at £4.1 billion, and they had a rights issue back in January, which diluted the existing shareholders by nearly 40%. Of course, it's very cheap on paper, but it's very cheap for a reason. I have invested in utilities before in the UK with Centrica, and I got quite badly burned, although I probably broke even just about with that. I think the whole industry, water being particularly bad, but it's a political football. You've got huge regulation and huge bashing of these companies, which often haven't been very well run anyway. And I would just stay well clear of it. Sam, what are your thoughts?
I feel like it's arguably a failing of the regulator, actually, that they've been able to accumulate this much debt whilst paying out such a high dividend for so long, when they know that this infrastructure investment is coming. So when you look, they've got, in the next 5 years, they've got to spend £3.2 billion on their infrastructure, on capital expenditure.
Yeah.
So what we're seeing now is actually going to get worse. And look at that equity raise. They may well have to do another one, but yeah, I mean, it's uninvestable probably at the best of times. But yeah, that debt is astronomically high, and it's only going to get higher. I don't know. Maybe once the investment's been made, but I don't know enough about the investment and whether it's going to generate extra revenue, or if they just kind of have to do it. Not that I'd be interested in finding out, but yeah, it's just looks like a terrible business. And then the fact they've been allowed to get into this position whilst just paying out all these dividends for years. So that's the other thing. Even at like the best of times, you can now get a prospective yield of 5.6%. I would argue there's quite a lot of risk with that 5.6% yield now, because at some point they're probably going to have to cut the dividend. And then when you compare it to what you could get in even just a normal bank account, and before we even go into the discussion of gilts, I don't see a huge amount of capital growth. I just don't know. It's a lot of risk for 5.6% now when you look at it, I think.
Yeah. And I think that's the thing. When I bought Centrica, which would have probably been 2016, it looked quite different because you were still in ultra low interest rates and it was almost like a bond proxy. There was more of that sort of argument going on with it. Whereas I think with all of these utility companies now, and what you get when the base rate is much higher, changes it completely. And even then, I mean, it's an uninvestable business full stop, but there was more of an argument 10 years ago for some of these businesses.
Yeah, I think in a zero interest rate environment, it is a different conversation. But yeah, I just don't know why anyone would want it for a 5.6% yield.
Okay,
Yeah.
I think enough has been said on that. Shall we move on to a business that we both quite like, B&M?
Yes, so it is a business we both like. I don't think it's a business we've covered for quite a while. It feels like it might be a couple of years since we last covered B&M. But for anyone who's not familiar, they are the discount retailer, so you will see them in retail parks. And they have come out with their full year results. And the revenues increased 3.7% on a 52-week comparative basis, primarily driven by the contribution from new stores. Group adjusted EBITDA pre-IFRS 16 was 620 million, and that's in the upper half of the guided range from February 2025 and is 0.6% higher than the previous year. Group adjusted operating profit is 591 million, and that decreased 1.8% due to higher depreciation from the asset base. Robust group gross margin performance was underpinned by an increase in B&M's UK trading margin, which rose by 42 basis points to 36.7% due to increased general merchandise sales participation and clean sell-through during the year. Operating profit was 566 million, and that decreased due to higher depreciation and adjusting items, with profit before tax of 431 million, impacted by increased interest and finance costs. So post-tax free cash flow was down 18.5% to 311 million. Dividend was up 2% to 15p a share. The group profit before tax is down 13.2% to 431 million, and the statutory diluted earnings per share is down 13% to 31.8p a share. And the group cash generated from operations was down 9.1% to 784 million. They've said the post-tax free cash flow decreased to 311 million was principally with a year-on-year working capital outflow from increased stock holding, leading to lower free cash generation. They've said the net debt to adjusted EBITDA leverage ratio of 1.26 is worsened from 1.17x, and the net debt including leases has increased from 2.4 to 2.56. The group adjusted return on capital employed is 30.4%, which I think is excellent, although an adjusted return on capital employed I would take with a pinch of salt. I would prefer the actual return on capital employed. And 2.1 billion was returned to shareholders over the last 5 years. And that's on a market cap of 2.65 billion. So it's quite hard to knock that, actually. That's a pretty good figure. They opened 70 gross new stores across the group, and that's 45 in B&M UK, 14 in Heron Foods, and 11 in B&M France. And the pipeline's well set for next year. In terms of the performance by geography, the UK revenue grew by 3.8%, France revenue grew by 7.8%, and Heron Foods revenue decreased by 0.6%. Adjusted operating margin, UK decreased from 12.4 to 11.8%. France decreased from 9.5 to 8.9%, and Heron Foods decreased from 4.9 to 3%. And there were a few more things in the annual report as well. So I just want to focus on the France business a bit, because this is something that's picked up quite a bit since we last covered it. But they've said in the annual report, France has continued the transformative journey that it has embarked on since acquisition. All stores trade under the B&M banner. The proportion of fast-moving consumer goods sales is increasing as we expand the range, leading to higher sales densities, and we continue to gently expand our new store opening program. In general merchandise, the product mix has evolved with a greater focus on home and the phasing out of clothing. This product realignment, along with the B&M branding of the stores, has been well received by the French customers. France has a similar population to the UK, and over the long term, the French discount retail market is less competitive, and therefore we expect France to continue to build sustainable profit for many years to come. In terms of size and wealth, France has a similar population to the UK, where we target over 1,200 stores. Since its acquisition by B&M in October 2018, the French business has undergone a significant transformation. All legacy Babou stores have been converted to be B&M stores. Since the acquisition, the French store network has also grown by over 40% to 135 stores. So there's 135 stores, and they think they can grow it to 1,200. That does represent a huge opportunity. I'll be interested to see if you can guess this, John, but it actually does remind me of another business that we cover fairly regularly. I don't know if you'll guess which one it is.
Greggs? Oh, no, Premier Inn, sorry.
Yes, Whitbread. It sounds like a very familiar tale to Whitbread and Premier Inn, where they're just taking the same product, rolling it out in a country where the demographics are quite similar, but for whatever reason, that particular segment of the market has just never evolved. And it seems to be going quite well. So in terms of the share price, these results aren't amazing because it seems like the core UK business hasn't done hugely well and they're relying on new store openings. However, this was a stock that did very, very well in COVID. When you look at the share price, it's really taken a tumble since we last looked at it. So it peaked over £6 a share during COVID. It's now under £3 a share. It's £2.64. It's now trading at a P ratio of 8.5 and it's yielding 3.64% for what I think is a pretty decent core business. In COVID it did really, really well because a lot of its competitors were shut, and I think it gave back a lot of those gains in terms of market share that the market maybe wasn't expecting. But it is still fundamentally a good business, I think. But then as well, I did have a look at why the share price had performed so poorly since we last looked at it. So it said UK like-for-like sales dropped 3.1%, missing internal predictions. And the company recently had parted ways with the CEO and announced job cuts. And they were demoted from the FTSE 100 to the FTSE 250. I don't think the UK business seems to be doing amazing, or has been since we covered it, but a lot of it seems to have been giving back the COVID gains. I don't think it's fundamentally a terrible business. And I think the French side of the business looks really good. I think the only risk is that there maybe isn't there with Whitbread, is the UK business has to perform at a certain core level to enable them to comfortably invest the money in the French side of the business. With Whitbread, they don't have that issue because the UK business is doing well as well. And then they're able to just plough the money into Germany. So they do need to keep their eye on the UK side. But I think it's a decent retailer. I think the French side looks very interesting. If they can go from 135 to 1,200 stores and you're getting it at 8.5 times earnings with a 3.6% dividend yield, I think it looks pretty good value. It's certainly a lot better value than when we last covered it. I think it was around 20 times earnings at one point from memory. John, what do you think?
Yeah, I think there is a value argument to be made for it. I think, as you say, it's had a number of headwinds, and it had those really favourable tailwinds during COVID, when a lot of stores were closed, but it managed to be one of those essential retailers. And it was a bit questionable how that happened, but it did. So it had arguably an unfair advantage back then. I think when you're operating at this end of the market and the margins are fairly thin, it's very difficult when you've got some of those costs coming through, particularly with the national insurance hike. I do quite like it, and I think the thing that's drawing me to it is that French market. And I suppose the fundamental question there is, was there or is there a reason that you don't have such a dominant value retailer in France? Why is that? But if there isn't a good reason for that, and B&M can essentially expand and grow into that, then at under 9 times earnings, it's pretty attractive. I guess there is that sort of inherent risk in terms of the consistency and the earnings from the UK business that, as you say, you don't get with a Whitbread Premier Inn type investment case. But no, I think it's a more interesting one to follow now than, as you say, when we were following it and it was much more expensive. Certainly now I think it's sort of de-risked it to an extent if you were to have more of a value play on it.
I think for me, I do like it. I like it for similar reasons to why I like Whitbread. The issue is I dislike it for the same reason, and that's the industry. And I think in the same way with Whitbread, it seems to be a really well-run business. If someone was to sit here and explain they've invested in B&M and here's why, I think they can make a really solid argument, and I think they could do very well. But I'm just not keen to add a UK retailer to my portfolio in the same way I don't want a hotel company.
Yeah. Fair enough.
I think there is an interesting opportunity there. I think I'll be more keen to follow it going forward and not leave it another couple of years.
Okay, fine. Shall we move on to Doc Martens?
Absolutely. How are they doing?
So, for anyone who doesn't know Doc Martens, it's Northamptonshire boot maker. They do their iconic Doc Marten boots. They're listed on the FTSE 250 and they had their full year results out. with revenue declining by around 10% to £787.6 million. Adjusted pre-tax profit dropped 64% to £34.1 million, but did beat market expectations, which were £30.6 million. Net margin was steady at 7.9%, and the dividend was cut from 5.84 pence a share to 2.5 pence a share for the full year payout, which is approximately 1.5%. Net debt, excluding leases, improved to £94.1 million, down from £177.5 million, with inventory reduction. They commented that they failed to take full advantage of shoes, sandals and leather goods offering, adding that the direct consumer approach led to a loss of coverage and responsiveness to their wholesale offering. The core boot business fell, and that's critical because it accounts for more than half of the revenue. Online sales of shoes, mules and sandals grew, excluding boots, but shop sales were down. They commented on the persistent challenges in America, which is their largest market, including a slowdown in sales as consumers reduce spending and supply chain problems at the distribution centres in Los Angeles. That episode forced the brand to lease a temporary third-party warehouse. The overall strategy seems to be pushing for that wider range that they've mentioned before and also trying to cut the discounts. In terms of the group's valuation, they have a market cap of £719 million and they trade at 30 times earnings with a dividend yield of just under 1.5%. Since listing in 2021, the shares are down 80%, and I thought that these results were pretty concerning. I think one of my issues with the business in the first place since listing is, yes, it's an iconic brand, but it is really focused around the boot. And you've seen the boot sales decline, and arguably it could be down to fashion, and it's not my sort of fashion, but it's fashion changes. They're not really, or they haven't really been able to keep on top of that. Yes, they're trying to widen the range, which makes sense. They sort of have to, but I think that's very, very concerning. And I would question how much they're able to do that, given how much the brand is focused around the boot. I think it's still expensive for what it is. And yeah, I just don't think it's a diversified enough brand to be able to sustainably grow or even hold what it's doing currently. And I think that's very worrying. You mix tariffs into that too, and it could be even worse. I'd just be staying well clear. Sam, what are your thoughts?
Yeah, I think it's really, really concerning. I think interestingly, it's kind of anecdotal, but I've asked Perplexity why it's done so poorly. And one of the things it's flagged, apparently there's a lot of stuff online where people are saying that the boots are much lower quality than they used to be. And that's since they've outsourced it to Vietnam and China. And apparently there's a lot of stuff where people have said that, we're going back a while, but they've had a pair for like 10 years or something that they bought in like the 90s or early 2000s, and then they bought another pair more recently, and it started breaking down with much thinner leather a lot sooner. As well as the iconic boots, they were known for the fact that they did last for so long. Whether there's much to that, I don't know, because when you look at it, they've been making the boots in Asia since 2003. So how much of a recent problem that is, I don't know. But anyways, it is concerning, and yeah, I think the issue is as well, I think in terms of the share price, I think it's still got a way to go before the white knight that is Mike Ashley comes in and saves the day. I think he'll let it drop a lot further, but it is the kind of business you'd think he'd probably have his eye on.
Coming to a Sports Direct near you.
Yeah. But yeah, it's really, really concerning. It's just been really, really poor performance since listing, actually.
Fine. What about Adobe?
So Adobe, I'm sure everyone's who works in an office is familiar with the Adobe products. They've got the Photoshop, they've got the PDF reader, they've got the digital signature, and they've got loads of other stuff as well. They are just everywhere. I think they're not quite at Microsoft levels in terms of not being able to operate without them. I think most businesses probably have a subscription to some kind of Adobe product, whether they like it or not. And I think a lot of them probably don't like it. So They have come out with their Q2 results, and total revenue increased 11% year over year to $5.87 billion, and all these figures are in dollars. Diluted earnings per share increased 12.9% to $3.94 per share. On a non-GAAP basis, diluted earnings per share also increased 12.9% to $5.06 per share. Operating income increased 11.9% to $2.11 billion. And on a non-GAAP basis, it increased 9.4% to $2.67 billion. Net income increased 7.4% to $1.69 billion, and on a non-GAAP basis, 7.3% to $2.17 billion. Cash flow from operations increased 12.9% to $2.19 billion, and the digital media segment revenue increased by 11%, and the annualized recurring revenue increased by 12.1% year over year. The digital experience segment increased revenue by 10%, and digital experience subscription revenue increased by 11%. Business professionals and consumers group subscription revenue increased by 15%. Creative and marketing professionals group subscription increased by 10%. And subscription revenue overall increased by 11.5% to $5.64 billion. Product revenue decreased from 104 to 88 million, but I think that's because they're forcing everyone onto subscription, so that's expected, and also it's a tiny part of the business anyway. They've also updated their targets, and they're estimating total revenue of between 23.5 and 23.6 billion. Doesn't tell you what that's an increase of, which is a bit annoying. These results are actually a bit annoying because they don't give you the percentages. I've had to work them out for the increases, which I dislike. So anyway, another interesting thing is, in terms of the valuation, it seems to have had a bit of a wobble recently. I don't know if it's quite getting into the territory where you would call it cheap, but it probably is getting into the territory where you would call it not as expensive as historically. So it trades on a PE ratio now of 24. However, in terms of the price to free cash flow, it's 17.5, and it is generating a lot of cash. It currently, for the last 12 months, has a share buyback yield of 6.7%. And when you look at the share price performance, it's not a million miles away. Well, it's probably 20 or 30% away, but it's not that far away from like 5-year lows actually. So it's got a 5-year high of about just under $700 per share. It looks like it's now at 376, and in the past 12 months, it has been as high as 587. It's also been as low as 332. In terms of why, because I think these results are pretty decent. It's kind of like high single digits, low mid double digits in some cases, a lot of the figures, which for a company of Adobe's size is just fantastic. So I've had a look at why it's down so much. Apparently it's mainly due to the pace and effectiveness of its AI monetization, as well as heightened competition in the AI and generative AI space. So after reporting these results, the shares dropped 8.6%. As the market reacted to modest near-term revenue growth prospects and skepticism about how quickly they can translate their AI investments into meaningful financial returns. So they've integrated AI features like Firefly and Gen Studio into its products and raised its annual revenue forecast. But there's a perception that their AI initiatives are lagging behind competitors such as Microsoft and Alphabet. And additionally, there's also competition from companies like DocuSign. However, I'm not overly concerned about DocuSign. We did cover it fairly recently, but I think the issue they've got is that their entire product is just a feature for Adobe. So they are competitors and they are a good company, but they don't do a huge amount besides the digital signatures. Whereas Adobe has a whole range of services and products it offers. So I find it a bit odd that the shares have reacted so poorly because the market doesn't think that it's actually monetizing AI well enough compared to like Google, for example, and Microsoft and whoever else. My concern would be that how many of the Adobe products could actually just kind of be replaced by AI. Because if I think of Photoshop in particular, if you can just upload something to an AI and say, do this to this image, how many Photoshop users no longer need it all of a sudden? So if Adobe, I suppose it's kind of linked, because if Adobe don't come out with that Photoshop kind of add-on where you can do that, but I just think when you play around with AI, you're not far off being able to just upload a photo and saying, I don't like this, tweak that. And without having to be able to use Photoshop, you just tell it what you want the photo to look like and it's able to kind of do that. So that would be my main concern. that's only Photoshop. I don't know how it applies to other parts of the business, but I would be more concerned about that. For me, it's a business I would really, really like to own, actually. I think the products are fantastic. I think it's almost at the point where it's like a tax on doing business in the same way that Microsoft is. In that if you run an office, you kind of have to have some of their products whether you like it or not. But I think a price to free cash flow of 17.5, I think it's still quite expensive, although it's come down a lot. So it's a business I took a look at actually when we had the Orange Swan, but I felt it was still quite expensive despite the drop. It might be for a business of Adobe's quality. I might not get to buy it at the valuation I'd like it at, but it's a business I'd really, really like. It is on the watch list and it's one I'll be following. And if it did drop further, but continue to put up these kind of figures, I would be interested in purchasing shares. What about you, John?
Yeah, I think it was interesting you picked up on the same point that I thought with AI, because that's my key worry with it. Is it AI proof? And I'm not sure, how big that moat is anymore with some of those core products, and whether you could have fundamental shifts in the market in the next year or two, basically. And it's obviously not cheap. I appreciate it's doing very well, good set of results, but that would be my main concern with it. So I probably wouldn't go near it just for that reason. I could be completely wrong, but that's a serious worry that I'd have with it.
Well, in any case, it's quite a way off the valuation at which I'd be comfortable buying shares in it. But I think for me, it's a business of enough quality with enough kind of strings to its bow that the main concern for me for AI is Photoshop. If I look at kind of the other parts of the business, I'm not as concerned. I probably need to dig in as to how much of the revenue comes from each segment and what I think effectively you could potentially, if you're going to do a worst case scenario, you just cross out and say, well, that's gone. But yeah, I mean, it's just not really near the valuation at which I'd want it. But I think it is a high enough quality business. And I think some of those parts probably are less affected than others. So I think that for me, there is a price at which I would love to own it, but it's not really close to that yet, unfortunately.
Okay. Well, of the companies this week then, Sam, what would be your top pick and what will come last?
So I think top pick for me, I would probably go with B&M. I think that looks interesting. I think the French side of the business looks really interesting. Bottom's difficult because it could either be Doc Martens or Pennon. I think I'd probably have to go with Pennon. I think the debt is actually really, really concerning. But Doc Martens in most weeks would be bottom. What about you?
I think I would go for B&M also. And yeah, again, Pennon would be my last. Just completely uninvestable.
Right. I think that's everything in that case.
Thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.